That's the closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Tom Hayes, as well as Yahoo Finance's very own Jared Blikre, joining us here to break down the moves today. Jared, my friend, we're going to start with you on that close.
Great. Let's dial up the Wi-Fi Interactive behind me, and we can see the Dow closing up 0.2%, not quite triple digits, but I think investors will take the 88 points, and that is off of those big headlines that we saw over the weekend, which, as I was saying earlier in the show, really would have moved the market 2-3 months ago, but not so today. Here's the Nasdaq Composite. That's up about 0.25% behind me. S&P 500 barely 14 basis points, so not a big day for that particular market. And then we have the small caps. Russell 2000 up about 0.5%. That was the leader today. And I also want to take a look at the VIX Volatility Index. We did see that jump just a little bit, but 17 is an historically low number. I'll just show you the year-to-date real quickly on that, and then I'll jump over to the bond market. You can see hovering near those year-to-date lows, and also here's that bond market VIX, the ICE B of A Move Index, that is up a little bit, but also off of the lows of the year. And wanted to take a quick look at the 30-year. That closed at 4.97%, pretty close to that 5% mark. That's something we've been talking about here. Also up today was the US dollar index, and I'll show you the intraday chart. That was a year-to-date, and you can see up about 0.25%. And let's switch over to and get a picture of the sector action. Communication services in the lead. That was up almost 1%, and that was off of Alphabet. That was also off of Meta and Netflix wins there. Financials, we'll cover that in a second. That comes in second place. Then real estate, industrials, utilities, and consumer discretionary. That rounds out the top line that you see. And what didn't work today? Energy. Crude oil was down 1 or 2%, and we saw energy tumble off of some of those headlines over the weekend. Materials also down about 0.5%. And if we take a look at the Nasdaq, we're going to see a little bit of red towards the left hand of the screen. That's only 3 stocks there, although they make up a big percentage market cap wise. If you take a look at the equal weighted here, I'm going to sort by performance. You can see more winners than losers here. The biggest losers on the day, Micron and Lululemon. And let's take a quick look at the chip market, because this was a sore spot for the market today. Not Broadcom, but Nvidia down about 0.5%, Taiwan Semi down 0.7%, and that was led by those Micron losses that I was just covering, about 0.5%. Also in tech, we see software, some of the big names slipping there. Microsoft barely to the downside moving, but some of the bigger names, or some of the smaller names, excuse me, really popping here. Autodesk, Shopify, Twilio, all up more than 4%. DocuSign almost there with them. So not a terrible day for tech. We did see some gains in the software space. One of the things I've been tracking since I came back here after that 3-week hiatus is all of the smaller stocks. Now, Tesla is not a small stock, but if you take a look at the components in the ARK Innovation Fund, guess what? Roblox up 5%, and a lot of the smaller names also up. Finally, here is the meme stock list. Remember those from about 4 years ago? I have kept that in the rotation here in my charts and my heat map, and we've seen a lot of action from those over the last 3 weeks. So some of the big stocks stumbling today, but a lot of the smaller stocks really liking the action. Small caps led the day.
All right, Tom, I want to get your thoughts as well. It's interesting that, as Jared was pointing out, you had these big headlines over the weekend, Trump and tariffs, and yet again, you just see the markets shrug it off. What do you make of that?
Well, I think the market's used to Trump's negotiation strategy of punching people in the face and then offering them an ice pack and kind of backing off. And I think the big theme, though, in listening to Jared was small caps being the leader. And that's in line with the laggards leading for the second half, because a lot of managers were caught off sides and they got to buy what's down in order to catch up to the indices. You can't buy the indices when they're already up. So continue to watch that theme. Consumer discretionary was out of favor first half. Small caps were out of favor. Energy was out of favor. So I think there's going to be some opportunities. That doesn't mean the others won't go up. It just means that your relative value is there.
Let me ask you about this. My colleague Josh Schaefer writing about this today. A number of firms, Josh, pointing out on Wall Street, raising their SPX targets for the S&P 500. Points out RBC goes to 6250. Apparently was at 5730. Here's what Lori Calvasina writes over there. She says, we feel actually neutral, she says, on the outlook for stocks in the second half. Says, mindful that our new price target is essentially in line with recent levels. Says we expect choppy conditions in the back half of the year and swings in both directions. You say what to that?
First boss in the business, first hedge fund I worked at, my boss taught me the most important thing. only key thing he taught me. Opinion follows trend. And they got caught flat-footed, and now the market's run away from them, so they've upgraded. They'll upgrade again when the market runs away from them. Let me give you a statistic. The market's been up 25% off the bottom in the last 3 months. The last times that this has happened since 1950, the average return 12 months out is another 23%. So RBC will be taking 6250 to 6500 when it's at 6700, and 6500 to 6900 when it's at 7000. I'm not saying that happens tomorrow. I'm not saying we don't get volatility in the fall. I'm just saying that if you look under the surface, there's still a lot to do. I mean, I got a lot of new money in this quarter, and I was a little concerned. I'm like, markets feel a little frothy. And then I looked at some of the opportunities out there that weren't the heaviest weightings of the S&P 500. I'm like, this is easy. Like, there's real value that I can generate great returns for my clients, and you just got to look for it. And skate to where the puck's going, not where it already is.
Talking about where it's going next, let's talk about earnings season that's coming up. Jared, I want to start with you there and talk about the big banks. They're going to kick us off, Jared. You look at that XLF, my friend, nice move off those April lows.
Yes, and not only that, behind me, this is a price action today in the big banks. Nice little lead up to those headlines that we're going to get tomorrow morning before the market opens. Who is reporting tomorrow? We got JP Morgan. I'm going to try and circle all of these. Wells Fargo, then we got Citigroup. We also got Bank of New York Mellon, and also BlackRock, the largest asset manager in the solar system here. And a lot of the things that investors have had on their minds this year with respect to banks is a deregulation tip that Trump ran on last year as part of his platform, but also the interest rate situation here. We are seeing longer rates creep higher, and that potentially creates a situation for net interest margin being a bigger contributor to their balance sheets. And also, I would take the consumer. We're going to get a lot of statements from Jamie Dimon tomorrow morning. Every quarter, he releases a very detailed note, and we got to listen to his statements, his opinions on the economy. He's not always right, but the guy moves markets, so we're going to be listening to that. And then finally, I just want to show you what's happened over the last 3 weeks. Since the June 20th bottom here, it was only a minor bottom, we've seen a lot of thrust here. Financials, you were just mentioning XLF, that large cap ETF that covers the financials in the S&P 500, that's up 4%, and that's in 4th place. We have 3 others that are above it, but those are above 5%. So a very strong showing from the banks since that June 20th low, and expectations are pretty high for tomorrow. Not too high, but for the rest of the week as well.
Tom, your thoughts on this upcoming earnings season? Is this going to be a positive catalyst for the market?
I do think so. I think we're going to get some follow through here. And, you know, the thing about V recoveries is overbought can stay overbought for a while, especially when there's so many people off sides. And who is off sides? Honestly, the retail investor has been right since COVID, and institutions have been too pessimistic, and they're still not at extreme levels. So secret to happiness, low expectations 4.8% earnings growth, down from 9 and change. It's a bar you can step over. I think it's going to be stepped over. The key is going to be guidance, and I think guidance is going to be better now that uncertainty has lifted a bit, certainly much more than when they were reporting for Q1. I
hear some strategists saying, interested to get your take on this, that now more than ever they'll tell their clients, you got to do your homework. What they mean is, specifically they say, Tom, you got to figure out who has the pricing power right now to navigate tariffs and who doesn't. What do you make of that argument?
I think there's definitely something to be said for that. I think the other side of that coin is the ones that don't have that pricing power have been repriced at such an extreme discount to the worst case scenario that you're probably getting more value there than looking for the ones that everyone's been crowding into that they think are completely unaffected by tariffs.
Fair point.
Yeah.
Thank you, Tom.
Yeah.
Shifting gears now to Tesla, CEO Elon Musk looking at intertwining his xAI startup with the EV maker. Musk sharing on social media that Tesla shareholders would have the chance to vote on whether or not to invest in xAI. And Yahoo Finance's senior reporter, Pras Subramanian, joins us now to discuss. Pras.
That's right, Josh. The Muskonomy in full effect here. Musk saying if it was up to him, Tesla would already own a stake in xAI, but now shareholders will have a chance to weigh in. Curiously, it follows after SpaceX, Musk's other company, reportedly invested $2 billion in xAI, which of course Musk already owns. Now, it wouldn't be the first time Musk intertwining companies buy stakes or even outright merge, which raises a conflict of interest. But Josh, last week, you guys had on Dan Ives, and he said the end game here is likely Tesla taking out xAI, regardless of Musk claiming he doesn't want that.
And Pras, I also asked Ives, it was interesting because your take on this. I asked Ives, who remains bull of bulls, he's got an outperform, he tells his clients this is one you need to commit capital to. And I asked him, big thesis, how come, Dan? Because Dan also, as you saw in that interview, he clearly frustrated with Ives wading back so hard, Pras, into politics, starting this American political party. And Ives' bottom line continues to stay pat on the table on this one because he told me he tells his clients this will be one of the biggest winners in AI, full stop, along with NVIDIA. What do you make of that argument?
I mean, I think I sort of understand where he's coming from with the fact that if you were to actually merge xAI and Tesla, you have this sort of AI powerhouse where you have Tesla, Dojo, you have robots like Optimus, you have the robo-taxis themselves, all powered by machine learning and AI, right? That's the kind of big bet. And I think that's what sort of, Ives is okay with Musk sort of slapping him with the "shut up, Dan" commentary, because he sees big picture, right? Musk is just going to be a mercurial guy that will eventually, in Ives' mind, refocus and bring back Tesla to where he thinks it will be from I think a 500 price target company, right? And many more down the line. So that's the big bet there. And I think he expects, Josh, I believe you said 50% chance that they approve this new pay package that he sort of put out there, right? That has guardrails for Musk too.
And Tom, I want to get you in here. As the one person here, Tom, who actually invests money professionally, we should get your opinion. You want to own Tesla?
Well, look, we don't own it. We've never owned it, for better or for worse. I will say that the unintended consequence of removing these EV subsidies may in fact be they're the last man standing as the Rivians go by the wayside, as the big three invest less in EVs and more into hybrids. So I think there's always going to be a niche market for that on their base business. And then as you add in some of these factors like the humanoid robots, autonomous driving, you got a lot of upside catalysts. I invest more for free cash flow, so this falls outside of my framework, but I could understand why people would be interested in betting on Elon Musk. He's proven himself over and over. He's like a cat. He's got 9 lives, and he'll come back with something that'll probably wow the world. Are
you interested, Tom, in that broader robo-taxi theme where Musk, of course, taking on Waymo? Does this space interest you long term?
Yeah, it's interesting. I mean, when Musk did that thing in Austin with one vehicle, a couple vehicles with drivers in it, the stock went up $10 billion. Google's been executing on all cylinders with Waymo. It gets absolutely zero credit attributed to the stock. So I like the theme, and the question is going to be rollout. I think Waymo's got the lead, and I think Musk is going to try to figure out a way to catch them, if not surpass them.
All right, Pras, thank you. And of course, a big thank you to Tom Hayes for hanging with me this afternoon. Any final thoughts, Tom, for the audience?
I think just be wary of, you're going to see a consensus of people saying the market's now overbought. And a lot of those people are people who missed it. V-shaped recoveries tend to push a little bit faster than everyone expects, even if they're ungrounded in the fundamentals. So just be wary of that. We might push a little higher. Maybe we'll get some volatility in the fall, but the underpinnings of the economy continue to be strong. And the tax cuts, that one big beautiful bill, you could argue different sides of it. That's growth positive, as Jose was saying earlier. So we continue to be constructive. Just got to do a little more work under the surface to find the good opportunities.
Overbought, but can still move higher.
Yeah.
There you go. Thank you, Tom. Appreciate it. Coming up, a C-suite shakeup with consumer health company Kenvue. We're going to get you the details on the other side. Stick around. Much more market domination still to come. A C-suite shakeup with consumer health company Kenvue, the owner of brands such as Neutrogena and Tylenol, announcing a CEO transition and actions to unlock shareholder value. For more on this, let's bring in here Yahoo Finance's very own Angelina Kamani. Anj.
That's right, Josh. We heard today that Kenvue, which is the former consumer umbrella for J&J, did let go of its CEO. And this transition is coming at a time where they've already had some activist investor pressure. We know that this company has also been, the activist investors have also been really active in the other biotech spaces and pharma company spaces. So interesting to focus on the consumer brand. Kenvue spun out in 2023 from Johnson & Johnson. We've had several conversations with the now former CEO, Thibaut Mongon. As you can see on your screen, these are some of the notable brands under that umbrella that he took out from J&J. And I remember at the time that, when we talked to him, he was talking about how this Kenvue now became sort of the biggest pure play consumer health brand $40 billion market cap, a really big company with household names. And the fact that the company now has to really focus on a lot of its skincare and health and beauty brands, and the sort of moves that have been called for really takes this company in another direction. I want to harken back to what Thibault had told us, if you want to take a listen to what he told us a couple of years ago.
What we see in our portfolio is that consumers, more than ever, are focused on their health and well-being. They are looking for products that are efficacious, that they can trust, that are recommended by their healthcare professionals, that has been in their medicine cabinet for many years, many decades, sometimes a few generations. And that's what we offer at Kenvue with our portfolio of iconic brands.
And yet those iconic brands being forced to change again by this activity. They now have named interim CEO Kirk Perry, who has led Procter & Gamble in the past. So obviously looking at some of the brands themselves and looking at resetting what that portfolio looks like. Kenvue has, and in the past when it was part of J&J, had always been kind of facing some of the same retail pressure that we often see with seasonality and the change of trends and the like. So that has been something that the company has had to keep a focus on. And you can see in sort of the stock action that there hasn't been too much activity as a result of the fact that, Wall Street is basically thinking that this is going to be a long-term plan to play out rather than something that has more short-term impact.
And Anj, you mentioned those activists, so Starboard Value, reportedly Third Point built a stake in this one. How much of this CEO shakeup, Anj, do we think was about trying to make those investors happy?
It does seem like it has a significant contribution to that. So we know that some of the board members have pretty much voiced something to that effect, that there is a need for a shakeup in the brand and kind of helping it move forward. In general, consumer brands have been once spun off from pharma companies, have sort of faded into the background. And it seems like because of the iconic brands that are associated with this company, there's been a push to kind of maintain that kind of relevance. And this is sort of where they're looking to unlock more value after the IPO as a standalone in a way that we haven't really seen with some of the other brands that were spun off from Pfizer and others years ago.
All right. Thank you, Anj. Well, the cost of healthcare is expensive for America, and that spending could get more complicated in a post-Big Beautiful Bill era. Senior columnist Rick Newman digging into the details and join us now. Rick.
Hey, Josh. I think we've been so focused on what's happening with tax rates and tax cuts, adding to the deficit, and then everything that's going on with tariffs. A really big thing that has been overlooked is what Trump and his fellow Republicans are doing to the social safety net. This is mostly through spending cuts that are in the tax bill Trump just signed, but some of it is separate actions that the Trump administration is taking. Put it all together, we're going to see the biggest cutbacks in federal spending on healthcare and in federal spending on food aid ever. These mostly we've been expanding these programs. We've made a lot of progress in terms of reducing the number of people who lack health insurance. That, of course, is due to the Affordable Care Act. And food aid goes to some 40 million Americans. The Trump, the tax bill and other Trump actions, we're going to cut each of those by about 16 million. So that's a 10-year window. So 10 years from now, if nothing changes, we're going to have 16 million people uninsured who would otherwise have insurance, or we're going to have 16 million people who are going to have to go through substantial cuts to food aid. And in some cases, those will be the same people. Some people are going to get it on both ends and get that double whammy. So when Trump became president the first time, he talked about repealing and replacing the ACA. That's not something Republicans are really talking about anymore. Yet they are kind of doing the same thing and almost at the same scale once all these changes are in effect.
Help me, Rick, understand some of the numbers and how we get to them. You've thought a lot more deeply about this, obviously. Medicaid, for example, Rick, I was under the impression that if you work, yes, there are now work requirements for those benefits, but my understanding was if you work 80 hours a month or you receive job training or you attend school, you're still receiving those benefits. So where are some of these cuts going to show up?
Right. It's not one thing. It's a bunch of different things. And I think part of the Republican strategy here is to spread this out to maybe make it hard for people to notice or put all the dots together. But there are going to be more stringent eligibility requirements for Medicaid. And importantly, there are going to be tougher paperwork requirements. So it's going to be harder to qualify to be eligible for Medicaid. And then you're going to have to check in more often. You're going to have to prove on a more regular basis that you are employed. And these and a bunch of other things are just going to, they're just going to be people who cannot keep up with it or who don't qualify. So the Congressional Budget Office says this is going to reduce the number of people covered by Medicaid by 8 million by 2034. There are going to be other things that happen. That we're probably going to see some rural hospitals close because they require Medicaid funding. We're probably going to see nursing homes that close, or we might see the quality of care decline, or we might see hospitals that just offer less stuff. Maybe they're not. Maybe they're going to cut mental health services. So this is going to happen in a lot of ways, and that's half of it. The other half is making it harder for people to qualify for plans under the Affordable Care Act or Obamacare. And one of these is going to be the expiration of subsidies that help people pay those premiums in the first place. That will happen this year unless Congress re-ups those subsidies, and Republicans don't want to do that. So put it all together, about 8 million losing coverage through Medicaid cutbacks, and another 8 million who will no longer be able to get it on the Affordable Care Act.
All right, thank you, Rick. Appreciate it.
Yeah.
Time now for what to watch Tuesday, July 15th. Starting off on the earnings front, big banks are kicking off another earnings season. Reports from JP Morgan, Wells Fargo, and Citi coming in on Tuesday. JP Morgan announcing results for the second quarter before the markets open. Analysts expecting the largest bank by market cap to raise its 2025 net interest income forecast above $91 billion, beyond the $90 billion guidance it gave at its investor day in May. And taking a look at the economy, we're going to be getting fresh inflation data on Tuesday with the monthly CPI print. That's the Consumer Price Index. June CPI data expected to show a tariff-driven uptick. Economists forecasting both total and core CPI to tick up to 0.3%, signaling a reacceleration inflation as the Fed contemplates its next move with interest rates. And speaking of the Federal Reserve, a big batch of Fed commentary from multiple Fed officials coming on Tuesday, coming against the backdrop of rising political pressure from President Trump to cut interest rates ahead of that Fed FOMC meeting in July. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Ashley for a trend. Stay tuned.